This is Jody Trana with Chapter 9, Part 2 of Principles of Accounting. When a company sells on account, that can bring both benefits and cost to the business. The benefit to the business is that revenues very likely will be increased because it's easier to sell to people if they can purchase on credit. And there is a potential for a wider range of customers as well. There is, of course, an associated cost because some customers don't pay. We need to create some type of allowance or adjustment for customers who do not pay us. The reason is because we want our accounts receivable balance on our balance sheet to reflect a very accurate number of what we believe we can collect on accounts receivable. The first method that we talked about to keep track of amounts that are not collectible is the direct write-off method. This method, rather than trying to estimate accounts that will not be paid, we wait until we know that an amount will not be paid and then we write that amount off. Although this may make a lot of sense, it often does not reflect very well on our income statement and our balance sheet because oftentimes we do this kind of a cleanup all at once and then we don't have very good matching with our write-off expense and our accounts receivable or our sales. Let's review the direct write-off method for Gate City Cycles, who decided that they would not be able to collect the $700 account receivable from Sherry Silverthorne. When doing the direct write-off method, we immediately expense to bad debts expense the amount that is uncollectible, and we take it out of accounts receivable by crediting the accounts receivable account. Because the direct write-off method is not acceptable with GAAP for material amounts, we need to be able to use allowance methods in order to estimate our accounts receivables that are not collectible. The two methods that we're going to use are the percentage of accounts receivable method and the aging of receivables method. Using the allowance method supports the GAAP matching principle. This matching principle says that we should match expenses in the appropriate period as the sales that were earned during that period. So here you can see that we have done an allowance for doubtful accounts of $7,000. That creates a bad debt expense that will be reduced from our sales for this first period. You can also see the balance sheet at the bottom of the screen showing our allowance for doubtful accounts, $7,000, that reduces our total accounts receivable balance. This makes a net accounts receivable of $93,000 after we subtract our allowance for bad debts. Let's look at a few transactions for Smart Touch Learning based on the allowance method. On December 31, Smart Touch Learning estimates that $80 of its $4,400 in accounts receivable are uncollectible. Because this is an estimate, we're going to immediately expense this amount and then reduce our accounts receivable by posting a credit to the contra asset account for allowance for bad debts. When we're using the allowance method, we will only use bad debts expense when we are making our adjusting journal entry for the estimated allowance. This account will not be used when we write off specific accounts receivable amounts. That will just be done to the allowance for bad debts account. Now let's take a look at a partial balance sheet for Smart Touch Learning. Here we have the accounts receivable balance of $4,400 less our allowance for bad debts that we just set up. This means that our net accounts receivable and the amount that we truly expect to collect is $4,320. We're going to track these allowance journal entries for Smart Touch Learning by looking at the Allowance for Bad Debts T account as well as the partial balance sheet. Here you can see the $80 that we just estimated as bad debts shows up for January 1 as a credit balance in our Allowance for Bad Debts account. As a separate entry, we also need to enter any accounts receivable that we identify as truly bad, meaning that they will not be collected. On January 10, Smart Touch Learning determined that it would not be able to collect $25 from its customer Sean Clark. So that amount needs to be written off. Remember that we will not use our bad debts expense account for direct write-offs. We're just going to take that amount out of the accounts receivable account by crediting it, and we're going to set that up in the Allowance for Bad Debts account. That's going to essentially come out of that $80 that we originally posted there as an estimate. This is what our balance sheet looked like right after we made our journal entry to estimate the allowance for bad debts, essentially saying that we would now be able to collect $4,320 of our accounts receivable. This is our accounts receivable balance today, after we've written off the $25 for Clark. You'll notice that the total amount of net receivable has not changed. It's still $4,320. But we have reduced our accounts receivable amount by $25, and we've taken that from our allowance for bad debts account, which is now reduced to $55, so that the net amount has stayed the same. Let's take a closer look at the allowance for bad debts T account. It started out as an $80 credit when we entered that first estimate. Then we wrote off the $25 to Clark, which left us with a $55 credit unadjusted balance. When we posted that first $80 estimate for Smart Touch Learning, that number was just given to us. Now we're going to practice making that adjustment and finding what that dollar amount should be. We're going to do this using a balance sheet approach. We're going to try the aging of receivables method, but the percent of receivables method works nearly the same. The idea is this. Step 1, you need to identify a target balance for your allowance for bad debts account. You'll do that by calculating how much of your accounts receivable you believe will be uncollectible. With the percentage of receivables method, you take your accounts receivable times a percentage, that's usually an industry norm. For the aging of receivables method, we're going to take a percentage of the receivables at different ages and add them up. Once we have that target balance for allowance for bad debts account, our step 2 is to determine what that bad debts expense needs to be. We'll do this one of two ways. First of all, we will take our target balance that we came up with in step 1, and we will subtract our unadjusted credit balance in allowance for bad debts. So we're wanting to end up with a credit balance in the allowance for bad debts account. So if we already have a credit balance, we'll just need to subtract. But if we have a debit balance in the allowance for bad debts account right now, then to determine our bad debts expense, we're going to take that new target balance, which is a credit, and we're going to add it to the unadjusted debit balance that's currently in the allowance for bad debts account. So the first step is to determine what our target balance is. When Smart Touch Learning does the aging of accounts receivable method, you can see that they have multiple categories of ages. They have a 1 to 30 days, that would be considered current, and of all of their accounts receivable that is only 1 to 30 days old, they believe that only 1% of that is uncollectible, or $42 in this case. When the accounts receivable invoices get 31 to 60 days old before they're paid, we determine that there's a 2% uncollectible rate at that point. When the invoices are 61 to 90 days old, there's a 3% that is uncollectible. And there's a huge jump when they are over 90 days old. If our customers have not paid us within 90 days, we have determined from our experience that 90% of those amounts are not collectible. Adding all of those estimates up, we've determined that our target balance for the allowance for bad debts account is $185. Let's go back to our allowance for bad debts T account. This means that $185 is our desired ending credit balance in the allowance for bad debts account. You'll remember that our previous balance was $55. So we need to make an adjustment of $130, which will be a credit, in order to come up with that $185 ending balance. That journal entry will be bad debts expense for $130 and allowance for bad debts credit of $130.